Hey guys, Don Durrett, Gold Stock Data. So we're going to finish up. I've done 4 videos. It's going to be the 5th video, final one. For I don't plan to do another one. The first 2 were on development stocks, and then I did 2 on producers. So I did large caps um, above 1.5 billion, and then I did mid tiers 500 million to 1.5 billion, and now I'm going to do producers below 500 million. So let me share my screen. So I create my own definitions of mining companies. So here's my definitions, and they don't match, what Wall Street uses, but I like these definitions because they help me to understand risk. So when I said that I was doing like large caps, more than 1.5 billion, Wall Street doesn't consider that a large cap, but I do because there's not that many of them. So for me, a major is anything that's has a market cap more than 3 billion, and then emerging major is 1.5 to 3 billion, but they need to be producing at least 80,000 ounces of gold and 3 million ounces of silver. And then a mid-tier producer, I actually focus more on production than I do on market cap. So here I have mid-tier 300 million to 1.5 with 80,000 ounces of production, or silver 3 million. But sometimes I'll actually move a company into mid-tier based on production more than market cap. And then an emerging mid-tier is basically any producer that I think is trending towards becoming an 80,000 ounce producer, a 3 million ounce silver. So I'll put them there. And then a small producer, they just don't qualify. They're basically, they don't have any, they're not forecasted to reach that level. 80,000 ounces of gold or 3 million ounces. They're just going to be stuck below that level. Those are the guys getting the small producers. So for this video, I'm going to focus on these 2, mid-tier and junior emerging. So basically, any producer that has a market cap below 500 million and hits these 2 categories. Now, I'm not going to do any small producers. And so I have 18 stocks. So the first 10 are these 10 names here. They all have a downside of at least 3. And so basically there's quality names. So these are all top picks. The green is top 25, and then the blue is top picks. These haven't, these are potential top 25 names. So even though I call my list the top 25, I think right now it has about 35 names on it. So if it qualifies, my top 25 list is basically any company that prints as a 5-bagger or higher with a good risk reward. So if the risk reward is good enough, I'll put them on the top 25, even though 25 is an arbitrary number, basically. And then, so the ones that are blue are, they're top picks, but they're not, the risk reward just isn't quite there yet. They're kind of marginal. And so, but again, these are all at least 3 downside, which is the higher the number, the better. Basically 3 is a good risk reward stock. And then I have this quality rating, and it's mainly gives me a good feel. This is also risk reward. Downside has a lot of, it's kind of, I'm using them both together because it's just another indicator. For instance, if I have a company as a 3, but yet it's a B or a B plus or an A minus, it helps me to understand. It gives me another qualifier for the risk reward. Downside is just that all that is upside potential, 3-bagger, 4-bagger, etc. A 3 means it's a 5-bagger, 4 means 5-bagger potential, 3.5 means a likely 5-bagger, and then a 4 is a potential 10-bagger. And so there's no A's on this list, but we have a few A minuses, so they're kind of close. And we only have, is there any B minuses? There's no B minuses here. And so these are my next list. This is 10 stocks. The last 8 are all 2.5s. They're not quite as good a quality, but a little bit more risk, but they could turn into, a lot of these companies can improve. They can turn in, they can, go up a notch, for instance. They can go from A minus to A, B to B plus, B to A minus. So, and then one last thing before we begin going over the stocks is somebody tweeted that that I'm using, 1-bagger, 2-baggers incorrectly. Well, as you know, I like to create my own definitions. So as far as the way that I look at it, if a stock has 1-bagger potential, then that means it has potential to go up 100%. And they consider that a 2-bagger because it went up 100%. And I think that's how Wall Street kind of thinks of it. I don't know who defined these bagger things, but for me, I look at it as return. So a 10-bagger is 1,000% return, a 1-bagger is 100, 2-baggers 200. That's the way I do it. And some people say, oh, you can't do that, Don. Well, as you've seen, I create my own definitions, and that's what I go by. Okay, so let's begin. Gallano. This company recently had a game changer event where they had a 50-50 JV. I think it was with Gold Fields, and it's in West Africa, and they acquired it, 100% of it. And you can see that, it's trending well. And so let's see. So this company used to be called Asanko Gold, and they renamed themselves to Gallano a couple of years ago. So, Goldfield. So they had a 45%, and now they own the whole thing. But I think they have to give Ghana 10%. So maybe they only own 90. But this is a long life mine, so really solid free cash flow. They can expand their production with, or they can extend the mine life. So they paid 20 million in shares plus 85 million in cash, and they gave Goldfields a 1% NSR. So now they've really jumped 450 million market cap, good balance sheet, 55 million. Ghana, West Africa. I think Ghana and Cote are probably the two places that I like in West Africa, and then Burkina Faso and Mali have been having some problems. But Ghana, it's not like you're mining in Canada, but I don't have a problem with it. So they have 4.5 million ounces of gold, which is a lot of gold for what they're producing. And they're producing 150,000 ounces, and they're going to expand that to 200,000, or at least that's my target. So, it prints as a 5-bagger, currently printing about a 6 multiple. So it's they don't have a great pipeline, but they do have a lot of gold. So it's not a great stock, but pretty decent. The next one is Go Gold. Now, Go Gold probably, I have them in emerging mid-tier because they have 2 really good silver mines, silver deposits that they're building. Los Ricos South, Los Ricos North. They're gonna build Los Ricos South. Both of them really high quality silver projects in Mexico. The mainly underground. They can mine some open pit, but they can build these mines underground if they have to. So Los Ricos, I think they're being smart about this. So Los Ricos South has a lower CapEx, so they decided they're going to build it first. And once they get Los Ricos South built, then they'll focus on Los Ricos North. And Los Ricos is one of the best silver deposits in the world. 55,000 acres. They've been finding, like everywhere they drill, they find silver equivalent. So it's currently around 250 million ounces of silver equivalent, 120 grams. So, I mean, it's not high grade, but it is economic. And the CapEx on both of these projects, I mean, right now it costs, it's unusual to be able to build a mine now for under $200 million. I mean, it's getting really expensive to build these mines. And the CapEx for Los Ricos South is only $125 million to produce 6 to 8 million silver equivalent. I mean, that's a bargain. And the AISIC's going to be around $12, maybe 14. And then Los Ricos North is next. So after they build that, it has a CapEx of 220 million, which is higher, but it's a larger mine. They're going to produce 8 to 10 million ounces. So combined, it's 15 to 20 million ounces a year, and which is pretty good. It's excellent, actually. I mean, it's basically a very, very large mine. And then they have two tailings projects, which they've been mining, so they've been generating free cash flow. So they're producing around 2 million ounces through these tailings projects through Peral. It has 24 million ounces of silver equivalent. Plus, they have another one, Esmeralda. They haven't really talked too much about Esmeralda, but I think it could add another 1 million ounces. So basically, Peral is going to be doing 2 million for about 10 more years. And then they'll be adding, at least 15 million ounces at Los Ricos. So that's 17 million ounces. This company has potential to be a very big company. Now they have insider ownership at 25%, but I just keep waiting for somebody to buy them out. I don't know who it's going to be. I'd like it to be maybe Silvercrest would be a really good match because Silvercrest needs a pipeline. If we come down and we look at its valuation, it's currently at a 23 multiple, and the reason why is because they're building. Well, they haven't started building Los Ricos South yet, but that's why it's getting that value, because that 6 to 8 million ounces is on the horizon. You can see it, the multiple is 69 back in July. So in anticipation of Los Ricos. So it has a lot of juice. It's printed as a potential 23 bagger at 15 million ounces. And if you were listening to me closely, that's really the minimum target. I mean, they could easily get to 18 million, maybe even 20. So there's Go Gold is one of my favorite development stories. I think it just got a lot of juice, but I do think it will be acquired. I'm looking here for permitting when we can expect this thing to go into production. It's fully funded for construction, but I think they need to permit the underground. PFS was scheduled for last year. Looks like the production schedule for next year. Looks like they want to begin construction this year, or possibly early 2025. But they're getting really close. Los Ricos South is getting really close. Victoria. I've always liked Victoria because they have a really high quality mine in Canada. It's in a really good location. In the wintertime, they do have trouble mining at the same rate year round. It's like, in the wintertime when it gets real cold, it tends to, production tends to go down a little bit. They haven't had the best of luck ramping up, but they seem to be figuring it out, and they have another mine to build, Raven. I don't know when. It's probably, might be 5 years down the road, but it's 1 million ounces, 1.7 grams. So, it's basically, at least 60,000 ounces a year, maybe 80. And then they also have Eagle. So Eagle is, their flagship, which is it's probably going to be, it's going to be in production for a long time. It's a 5 million ounce property. And then they're also drilling Olive and Shamrock and Nugget in tandem with Raven. So Raven is a ways away from Eagle, and they want to build a separate mill for Raven. So that's going to take some time. But Olive, Shamrock, and Nugget are next to Eagle, which could conceivably expand Eagle. And I think Eagle will probably get to 250. And then Raven will add another, let's say, 75, 60 of us. Let's just put it at 50 at 300. So Victoria should grow into a 300,000 ounce company. And they also own 12% of Banyan, and Banyan is a really large deposit. I have here at 4 million, but I think it's much larger than that. I think it's more like 6, closing on an 8, but it's low grade. But they own 12% of Banyan. So also the CEO is married to this CEO of Victoria is married to the CEO of Banyan. So it's kind of a perfect match, right? I expect those two companies to merge, but they're going to have an agreement. That's an interesting story, interesting concept. If we look at Victoria's shares, I like this: 67 million and only 69 fully diluted. I mean, basically very shareholder friendly. Insider ownership. I think somebody would acquire this if they're for sale. I don't think they are. They do have a lot of debt, but now we have strong cash flow. I think it reduces the risk. So I have them with 6 million ounces of gold, and it's growing. Got a lot of gold. I expect some growth out of this company. They're currently producing 175,000. Eagles should be at 200, but they just haven't been able to ramp up. I think 200 was always their target, but I expect Eagle to get to 250, that mill. And then I'm only valuing them at 250 because Raven, probably aren't going to get there for at least 5 years because they have to build a mill. But I think 250 is a good target. They're high cost, they're about 1350 AISC. So not a low cost company. The thing that's great about Victoria is the location. It's just there's not a lot of mid-tier producers in Canada, and you just want to own them. And it currently prints as a 6-bagger, which is pretty good. And look at how cheap this thing is. The multiple's of 3 right now. It's just kind of silly cheap. I mean, just on multiple expansion alone, this thing could be a 5-bagger. So my 6-bagger is probably way too conservative. You get that big multiple expansion. Next one, Ascot. Ascot is another mid-tier producer, just went to first pour in Canada, and this one's in British Columbia. And Victoria is in the Yukon, I'm pretty sure. So Ascot just got to first pour. They, for some reason, investors just really never liked this project that much. It's 3 million ounces, which is plenty of gold. It's 7 grams. The capex was 225, which isn't super, a lot of debt on their balance sheet. They have a lot of drill targets. I'd like to see Ascot and Skeena merge because they're right next to each other, and it seems to be a really good fit. And it basically can protect the shareholders of both companies if they did a merger of equals. So let's see. They don't have much of, of of a pipeline, other than they have a lot of drill targets, and then they have this Mount Margaret project. But the problem with it is it's in the state of Washington. I don't know if they'll be able to permit it. Um, I wouldn't expect Washington to be kind of mining friendly for a big, huge open pit mine. The gold is only 0.25, so I mean, it's real 500 million tons is a lot of ore, but it's mainly a copper project, 4 billion pounds of copper, 4 million ounces of gold. So the gold's going to be your offset. So it could potentially be a low cost copper mine, but can they permit it? I'd like to see them sell this for like, maybe $50 million and just take that cash and pay off some of their debt. So I have only 51 million in debt, 59 in cash, but they were just building this mine. So that cash probably might have shrunk quite a bit. 650 million ounces, shares, it is a bit diluted. But 4 million ounces of gold, 100,000 ounce producer. I have them growing to 135. Again, the key here for Ascot's the location. Printing is a 5-bagger, and that's not going to last much longer. And their multiple right now is a little over a 3. I mean, that's why I said investors just haven't really liked this stock. I have them 100 million free cash flow right now. So do I have them? I know they got their first pour, but they're ramping up right now. Let's go take a look and see what their last news release was. Okay. First pour in April. So they got first pour, so it's really, really early stage here for ramp up. And a lot of times investors are very leery of, how well the ramp up is going to go. If, do they hit their grade? Do they hit their production numbers? And so there's always a lot of risk on the ramp up. It looks like, and they just did a $5 million private placement, but 5 million, it was only, they're $200 million companies. So it was a really small private placement. I don't know why they did that, because I thought they had, 50 million on their balance sheet. Why would do a little tiny little, it's kind of odd that they did a small one like that. Why would you even do that? Do they really need the money? I suppose that's a red flag. So again, I like Ascot a lot because of the location. So you got Victoria and Ascot both in Canada. So you really want to own mid tiers in Canada and Australia, in my opinion. Orzone, um, Orzone has been they built their mine and everything's been really, really well there. They've kept their costs down, good ramp up, paying off their debt fairly quickly. This is in Burkina Faso. Burkina Faso it's not as bad as Mali, but it's not, they've been having some issues in Burkina Faso. I think they currently have a military dictatorship that it basically had a coup there. Same with Mali. Both of them did. So um, they're so they ramped up production. They have it's a 5 million ounce open pit, and they're producing 120,000 ounces a year with an AISC of about 1350. So it's not a high cost mine. They're generating free cash flow, and now they're going to build phase 2. Now, the problem with phase 2 is going to take a while. So it looks like they're not going to get to 160,000 until 2026. And then they're not going to ramp up until 225,000 in 2027. So I was hoping that they could ramp up a little faster than that. Well, I said they report 180, but they only get 90%. Um, so we got to wait until 2027 to get to 225. That's a bit of a wait and so they have debt 62 million and cash 19, and they've been paying down their debt fairly quickly. 5 million ounces, so they have plenty of gold. So I currently have them this year at 110. I guess the grade, because they always mine a higher grade when they first ramp up. So it looks like the grade came down a little bit this year. They're at 110, and then I have them bumping up. So the cost, it's not a super low cost, but the margins are there. If you don't, as a 200,000 ounce producer, they also think this thing's going to grow a little bit. So even though I have it at 225 in 2027, this is a really good property. So they're currently printing as a 10 bagger. So, if you don't mind Burkina Faso and you want to own these companies that have this kind of leverage, over the next 3 years, if you will, they're currently printing. I have them as the multiples of 3. So a lot of these companies that are out of favor, if you will, with investors, they're just not getting any love. And I have them currently generating around 20 million free cash flow a quarter, 20 to 25, and it's a lot of free cash flow, and they're just not getting any value. So next one is Cisco development. Now, Cisco development is a really long-term play, but I think that there's a lot of value here for if you don't mind long term. They're valued at the current market cap is $235 million. And as far as I'm concerned, you're getting this Trixie mine for free because the Caribou mine is definitely worth 235 million. Caribou is in Canada, four plus million ounces underground, high grade. It looks like it's going to go into production in 2027, so it's a long-term bet. But once they get this thing into production, Caribou is going to be a thing of beauty. I mean, it's going to produce 200,000 ounces for a long time. Plus, they have a lot of drill. Caribou is a big property with a lot of drill targets, 80-kilometer trend. The company that owned it before Caribou said that they had 20 million ounces of surface gold. And Cisco says we're not going to mine any of the surface gold. But if gold goes to $3,000, are they really going to just completely ignore all that surface gold? Because there's a lot of it, anywhere from 10 million to 20 million ounces of surface gold. So they've been focusing on a high grade underground, but I got to believe that Caribou at some point, and you don't necessarily have to do an open pit. You can do stoping. I mean, you can find some, 2 gram per ton near surface, which they can do. So Caribou can expand. And then, like I said, you get Trixie for free. Trixie's currently in production, not very much. I think like 20,000 ounces a year, 15. But this is a 1 million ounce project with very high grades, 800,000 ounces at 20 grams. So this is going to be, a 50,000 ounce plus mine for a long time. They think the property could have 5 million ounces. And again, I think we're getting this for free. Then they have another mine, San Antonio has 1 million ounces in Mexico. And it has a low capex of only 25 million to mine 50,000 ounces a year. So, I mean, if gold keeps going up, 50,000 ounces can generate a lot of free cash flow. So they have they have basically 3 properties, 3 mines they can build. So it's a long term because really you're not getting paid until about 2027. So, but I think plus the insiders Cisco Gold Royalty owns 50% of it, so they're not for sale. They have a good balance sheet, 31 million in cash, only 14 million in debt, and it prints as a almost an 8 bagger, 7.5 bagger. It looks, pretty very interesting. Currently printing a 30 multiple, and that's because they're not getting any value for Caribou. So investors are basically paying up for when Caribou eventually comes online. But I do like it. I think I own every stock on this list, by the way. I haven't mentioned that going down the list. Yeah, I own every stock on this list. The next one is Alcane. And Alcane, I recently bought because I'll tell you why. So they're a small, they're emerging mid-tier. So they're a small producer today. They produce in Australia, and I just like Australia gold miners. They're producing 65,000 ounces a year at Tomingli, and it's a very long life. So they're currently 1.5 million ounces open pit, but it's growing in size. Tomingli has a lot of drill targets. So, and they think they're going to expand this thing to 100,000. This could be 100,000 ounce a year mine. And so just this project alone, I think, especially, and it's not high cost. They basically have about 1150 ASIC on this Tomingli project because it's a high grade open pit. And then the reason why I bought it is because their next project, it's two deposits. One is Boda and the other is Kaiser. And it's low grade, 0.45, and I think this is AQ gold equivalent with copper and silver offsets. But some of the holes on Boda, 689 meters. That's very wide at 0.46 grams per ton and 500 meters. So this is a very wide open pit at surface. Now, currently they're showing 8.3 million ounces of gold at 0.3 grams. I think the 0.45 is gold equivalent. But if gold prices rise and copper prices rise, this is going to be, 8 million ounces. This is easily going to be 300,000 ounces a year. And so let's say they take, Tomingli to 80, you're looking at about 380,000 ounces a year in production. The key is going to be, they're going to come out with a PEA. I'm doing a Zoom call with the CEO, and he's going to go over the PEA once it's released. But the PEA is going to tell us, what they think the ASIC is going to be on this. But the NAV is going to be, I'm expecting the NAV to be around $1.5 billion. Maybe I'm a little aggressive there. Maybe it's only 1 billion, but their current market cap is 233. So, and we're pretty much getting this Boda Kaiser project for free. So, the combination of location in Australia and the fact that Tomingli is a long life, high grade open pit that, is going to support this thing. And, we're probably going to get a 1, 2, 3 bagger just on that one alone. And then once they bump up, I'm only valuing them at 250,000 ounces. They print as a 10 bagger, but this thing, I think, could easily be 350 a year. So it's better than that. So I think Alcane looks pretty juicy to me. The next one is Jaguar. So Jaguar, I haven't liked Jaguar that much because the management team has been really conservative and they haven't drilled very aggressively. Not a lot of holes, and they've basically been very content to, mine 60 to 80,000 ounces of gold a year without much of a pipeline. And I've been following them, and I'm talking about over the last 5 years. However, they got lucky. They had a lot of targets and they were poking all over the place. And they found high grade gold, basically higher grade than they're currently mining. So at both of their current mines. So they have two mines right now. And both of their mines are currently mining at 50% capacity. So the CapEx is practically nothing to expand production at both of their mines. And they just, like I said, they got really lucky. They just keep finding more gold. They've been having really good drill holes. And have changed my tune on them, if you will. Now I'm very bullish, mainly because of their drill results. So this year they increased their M&I 25% to 1.7 million at 0.4 grams, and it was like 0.35, so the grade's going up. And their inferred went up 40% to 1.6 million. So they're currently at 3.3 million, which is a lot of gold, and they're increasing. They're finding more, and they're going to expand production. And all this increased gold is that there are two existing mines. So Pilar, they're going to increase production at Pilar about 30,000 ounces, and then 50,000 ounces at Turmalina. So they're going to they're basically going to double production with very low CapEx, because both of these mines are running at 50% capacity. And then once they get all that in, I mean, they're going to become a 150,000 ounce producer. They have high costs. They're only producing underground. It's about 3.5 grams, so it's not great. But their market cap is $163 million. If they're producing 150,000 ounces in Brazil, which is a good location, this thing could easily jump to 1.5 billion if gold prices go to 2,800, 3,000. Plus, they have a lot of drill targets. So the more cash that they get, the more they can drill. And so it just looks, better and better. I think long term, these guys can get to 175 or 200,000 ounces. And they're just plodding along. They only have 80 million. They have no warrants. Well, of course, they don't have any warrants. They've been producing for a long time, but they options. They only have 1 million. 1 million in options, which is great. Very conservative company. 60% insider ownership. Eric Sprott owns half of this company. They're not for sale. They're doing dividends right. They're even paying a dividend right now, 2%. I think that's going to, go up. So dividends, they're currently producing 70,000 ounces, which isn't great, but it's going to easily double. They're going to go to 150. So nobody wants to own it because they have high costs, 1,700. Their ASIC is about 1,450 at 4 grams. And so it's, but a lot of targets, expansion. It's just a good story. So they're currently generating about 45 million in free cash flow, which they can use to drill, pay dividends, and they're cheap. Currently, their multiple is 3.5. They print us 11 bagger at 150,000 ounces. I mean, what's not to like? I mean, it's a thing of beauty, really. Next one is Avino. I don't even know we need to talk about Avino, right? It's like, this is probably the cheapest stock going, but what the heck? Let's take a look at it. Avino, in my opinion, will not last. They got to get taken out. They're just silly cheap. They're currently producing 2.5 million ounces a year, and so they're not getting, they're only valued at 100 million. So they've jumped to 115. But their pipeline is amazing. They have 350 million ounces of gold, of silver equivalent. And they just acquired La Preciosa from Coeur. It has 135 million ounces at 180 grams with no base metals. It's just gold and silver. It's a very good grade. And the CapEx to mine it is really, really low. So they're going to start out. They have a plan to mine 3 million ounces a year, but 3 million ounces a year, look, it's 100. They got 135 million. It's not going to stop there. This thing's definitely going to ramp up to like 5 million ounces a year. and they're not, it's not even part of their projections. So, I mean, when you do the cash flow, it's just silly cheap. So they're currently in 2024, they're 2.5. Next year they go to 3.5. In 26, they go to 4, and then they stay there. And I think maybe because, if silver prices go nuts in 25, 26, I think they'll get aggressive and spend money because they have a project that they could, speed up a little bit, aggressively spend money. I think this is a conservative. The tailings project, I think they could more aggressively, if they get a permit for it, they could maybe get this to 5 million in 2027. So, but these are their numbers, and then 7 million in 28 and 8 million in 29. So if we only use, 4 million ounces, a 4 million ounce producer, at say $50 silver, you do the free cash flow, and this thing it's already silly cheap. I think I have some numbers down here. So here we have 70. I'm using, well, this is $100 silver. I'm using the 7 million ounces. This is in 2028, but you can cut them back a little bit. But in 2028, when they hit 7, if gold is at 100, I have their all-in cost at 30. So we have $70 in free cash flow times 7. That's 49, but I'm rounding it up to 500 million. So the current market cap is about 115. They have potentially 500 million in free cash flow. They get a 10 multiple. And if their margins are that big, $70, they probably will get a 10 multiple. That takes their valuation to 5 billion. And then if you can compare 5 billion to 100 million, that's a 50 bagger. Well, it's 49 bagger, but rounding. So the upside is just so huge that somebody's going to acquire them, because low capex, they already have all the silver equivalent in the ground. It's too cheap, and they don't have any insiders to prevent them from being acquired. 80% of their shares are held by retail. 80%. So it's just, somebody comes in and makes them an offer, they can't really turn it down. They have to allow the retail to vote on it. And these things usually always get approved because I don't know why, but it's like people are holding it to get a 10 bagger, and then somebody comes in and it's a more solid 5 bagger, and they'll basically, it'll pass every single time. So the combined resources for the Avino mine and La Precoce is 370 million ounces, silver equivalent 150 grams. So you can see that, I mean, that is just very juicy. All that silver equivalent, I mean, and they're valued at 115 million. And they only have 142 million fully diluted shares. They don't have they don't have a lot of cash because they haven't been generating. They've been basically losing money for the last year. But now that they don't have low cost, they're currently break even's about 25. So about a $20 ASIC, $21 ASIC, somewhere in there. They don't generate a lot of free cash flow. They've been losing money, but now, see, I have them at 28. Below, previously I used 30, but I'm thinking, in the next 2 years, they'll probably will be around 28. It's hard to project out like 3 years what the cost is going to be. But yeah, currently Prince is a 50 bagger. I have 500 million in free cash flow at 10x. It's printing 50, it's a 50 bagger at 7 million ounces. So yeah, it's like Avino's like, crazy cheap. The last one on the list is Lion One. I think this video is taking a while. I think I'm gonna have to do this one first, and then I'm gonna have to do that final one. They have the last 8 stocks tomorrow. Okay, so Lion One. Yeah, this is a stock I like a lot, but it has more risk because we just don't know how big this mine is. It's really a drill story mine because they, it's kind of early innings on, on drilling. So the deposit is currently only 800,000 ounces. But if you look at the drill holes, they have all these targets to drill out, these areas. And if you look at these drill holes, I mean, they've been outstanding. 88 grams over 5 meters. I mean, that's is, fantastic, right? 27 grams over 5 meters, 20 grams over 7, 16 over 9, 16 over 9, 15, 14 over 6. Anything that's 5 meters is for anything that's 5 meters, it's 10 grams. I mean, that's 150 gram meter. Any gram meter over 100 is good. Once you get to 150, it's really good. Over 200 is fantastic. I mean, those are really kind of the numbers. You go above 50 to 100 is, okay. Then once you get to 100, you're basically in good. And once you get to 200, you're in excellent. So these things are, these are the kind of drill holes these guys have been throwing out. This is from recent. This is 425. These are recent drill holes. It's not like these things are 3 years old. Very recent. I mean, this is what these guys are hitting. It's only valued at $100 million. This thing could conceivably could be a 5 million ounce mine. Now it's total guess, right? But I do think those kind of drill holes, I do think it's at least 2 million. So, balance sheet isn't terrible, 36 million in debt. Currently I only have them at 2.5 million, but I'm giving them, I'm basically saying that's what I think it's going to be. They don't say they have this much. I do. I basically, based on those drill holes, I think it's 2.5 million. So currently they're only producing 35,000 ounces, but it's going to grow. So I have them valued at 100,000 ounces, which I think is conservative. I think it's going to be much higher. So only at 100,000 ounces, it prints as a 10 bagger. So you can see and you got all those drill holes. It's currently printing. I mean, it's kind of silly. I mean, they're only producing 35,000 ounces and they're a 3 multiple. It's kind of silly that you would think with all that, with the kind of drill holes that they're having, it would be much better. But yeah, line one is, I like to look for stocks that are 5 bagger, at least 500% with 10 bagger potential. So if I can find a producer, I mean, we're doing producers here. If I can find a producer that's a 5 bagger with 10 bagger potential, that's what I'm looking for. So yeah, this whole list is, is pretty good. I mean, well, I said I own all of them. They're all top picks. Most of them are top 25. The only reason why Cisco and Alcane are not top 25s is because we got to wait. These are both 2027 stocks. So they'll go to the top 25 next year, probably, as we get closer, especially Cisco development. I would expect them to get on there next year. Alcane, maybe. And I don't see any of these guys really falling off because they get too pricey. But Victoria could fall off because it could get too pricey. Ascot could. Jaguar easily could fall off, and Avino. So a lot of these stocks are going to fall off. They're going to fall off the top 25. They're going to go to 2.5s because once they're no longer a 5-bagger, they're going to fall off the top 25 and they're going to go to the 3-bagger list. So these stocks are 5-baggers today, but they're all going to be, not all of them, but the majority of these are going to be 3-baggers. Once, let's say, the Hui gets to 350. So, all right, guys, we're going to end it there, and I'm going to come back and do the other 8 tomorrow. All right, let's end this thing. So I got to stop my share, and now I got to stop my recording. See ya.